Hello everyone, welcome to the economics class with me Biraj Chetri, PGT Economics Kendriya Vidyalaya. And if you have been following my classes, then you would know that we were discussing about foreign exchange rate in our previous classes. So this is the video related to the last part of foreign exchange rate, that is part 3 of foreign exchange rate, and with this we will conclude this chapter and the unit as well. And this unit comprises of 2 chapters, that is balance of payment and foreign exchange rate, and it will come off 6 marks in your board exam. Okay, so this unit comprises of 6 marks in your board exam. So alternatively, the question comes from BOP as well as from foreign exchange rate. Okay, so without making much delay, let us start with today's class, that is foreign exchange rate part 3. In our previous classes, we have discussed about what foreign exchange rate is, what do you mean by flexible and fixed foreign exchange rate, what is depreciation, appreciation, devaluation, revaluation, and as well as how depreciation is affecting import of foreign goods and export of domestic goods, how appreciation is going to affect import of foreign goods and export of domestic goods. This all we have discussed till our previous class. Now in this video we will discuss about some other aspects of this chapter, and let us begin with it without making much delay. As you know, in the flexible exchange rate system, the exchange rate, foreign exchange rate, is determined by the market forces of demand and supply of foreign exchange. Then obviously there must be certain factors which will be affecting demand and supply of foreign exchange, isn't it? So today we will discuss about those factors which will affect the demand and supply for foreign exchange. Okay, let us first discuss about the factors affecting demand for foreign exchange. What are the factors that will determine the demand for foreign exchange? What are the factors that will lead to the need for foreign exchange in India? Now, before discussing this, we need to assume one thing. It is that whenever an Indian citizen wants to purchase a foreign goods, he or she will have to make payment in terms of foreign currency. Let's say, for an example, US dollar. Okay, now whenever an Indian is going to purchase something which is made in foreign countries, then they will be making payment in terms of foreign currency, that is US dollar. And in order to make payment for those goods, they will ask for US dollar from RBI or monetary authority. So it is treated as demand for foreign exchange. Okay, and whenever an Indian wants to visit abroad for a tour, okay, it might be business tour, it might be just a holiday tour, then also that particular individual Indian citizen will require US dollar, okay, foreign currency, US dollar, and they will ask for that US dollar from the monetary authority of our country, that is RBI, okay, or the government. Fine. So whenever an Indian wants to purchase something from abroad, or whenever an Indian wants to tour abroad, or whenever an Indian company wants to invest abroad, then they will have to get US dollar from the monetary authority of India, that is RBI. Okay, clear? They will be demanding US dollar within the country. We are not talking about the demand for US dollar all over the world. We are dealing with the demand for US dollar within the country, that is within India itself. Okay, keeping that in mind, what can be the factors which are affecting the demand for foreign exchange? We will be discussing about that. Okay, the first factor which is going to affect demand for foreign exchange is import of goods and services. Okay, if Indians want to import more and more of foreign goods, more and more of goods made in USA, as well as Indian wants to visit USA, or they get the services of some software companies, like let's say they are using the software of Google, Microsoft, etc., then they are using the services of foreign country, they are using the services of USA. So whenever there is a need for goods and services of foreign country, then obviously the demand for foreign exchange, demand for US dollar in India will increase. Okay, and when there is less import of foreign goods, then obviously the demand for foreign goods, demand for foreign exchange or US dollar will decrease in India. Okay, the next is also related to this only, tourism. Whenever we tour abroad, we will be requiring US dollar, so we will ask for more US dollar within the country, that is in India itself. Okay, so this will also increase the demand for foreign exchange. This will also increase the demand for foreign exchange. And whenever the Indian citizens, like currently in current situation, since all the boundaries are closed, international boundaries are closed, so right now there is no demand for foreign exchange as such for tour purposes. Okay, fine. So whenever there is less plans for touring other countries, then obviously there will be less demand for US dollar or foreign currency. Okay, similarly, whenever those who are residing in India, those who are Indian citizen, wants to send some money to their relatives, friends, etc., who are residing abroad, or even to their, let's say, children who are studying, let's say, in abroad, either in England or in USA, then they have to make payment in terms of US dollar. Okay, and when they make payment in terms of US dollar, obviously there will be high demand of US dollar within India, and they will be demanding it from RBI. Okay, the last factor which will affect is investment to abroad. Whenever an Indian company wants to invest abroad, obviously they will require some foreign currency, and that foreign currency or foreign exchange will be demanded. And as a result, whenever there is more investment to abroad, whenever an Indian company starts investing abroad or increases their investment abroad, obviously there will be more demand for foreign exchange within the country. That is, there will be more demand for US dollar in India, not abroad, but within India there will be more demand, and RBI will have to fulfill those demand. Okay, based on all this, as the demand suggests, okay, we already have read about theory of demand in class 11, and we know that from the law of demand, we know that demand and the price of the commodity are inversely related. Okay, when the price of the commodity rises, demand for the commodity falls, and vice versa. Okay, so the same logic applies here also. Here, since we are dealing with the foreign exchange market, and instead of goods, here foreign currencies are being bought and sold. Okay, instead of goods, it is foreign currency. Okay, and instead of price is being replaced here by foreign exchange rate. Here foreign exchange rate is nothing but the price of other currencies in terms of domestic currency, isn't it? So in this case, in the foreign exchange market, what is actually happening is citizens are purchasing foreign currency by giving domestic currencies. Okay, so in this case also, price is foreign exchange rate, and foreign exchange itself is the goods, or foreign currency is the goods, and foreign exchange rate is the prices. Okay, now keeping that in mind, we will apply the law of demand over here also. Whenever there is high foreign exchange rate, there will be less demand for foreign exchange, and whenever the foreign exchange rate is low, there will be more demand for foreign exchange. So demand for foreign exchange is inversely or oppositely related to the foreign exchange rate. Okay, if we are to explain this, okay, why is there an opposite relation between the foreign exchange rate and the demand for foreign exchange? Why is there an inverse relation? If we are to explain it, then we can explain it easily with the previous knowledge that we have gained in our previous lecture. Okay, we have seen how depreciation of domestic currency is going to affect export and import of domestic country. In the similar way, how appreciation of domestic currency is going to affect export and import of country, isn't it? So we'll apply that knowledge over here, okay, in order to understand why there is an opposite relation between demand and supply, demand for foreign exchange and the foreign exchange rate. Okay, let's say when there is increase in foreign exchange rate. Increase in foreign exchange rate means nothing but the depreciation of domestic currency. Increase in foreign exchange rate means, let me give you an example of Indian rupees and US dollar. The example will be much clearer for you. Let's say initially at the beginning, okay, the exchange rate is such that $1 US is equivalent to or equal to rupee 60. Okay, now when the foreign exchange rate rises, increases, what happens is now you have to give more of Indian currency, that is more of rupees, Indian rupees against each dollar. Let's say now after increase in foreign exchange rate, you will have to give 70 rupees per US dollar. Earlier you were giving 60 rupees per US dollar. Now after increase in foreign exchange rate, you are giving how much? 70 rupees per dollar. Okay, so in other words, we can say that whenever there is an increase in foreign exchange rate, it means that there is depreciation of domestic currency. Our currency, Indian currency, that is Indian rupees, is depreciating over here. And whenever there is depreciation of domestic currency, we have already discussed about this in our previous classes, that the foreign goods becomes relatively expensive. Now for the domestic citizen, for the Indian citizen, foreign goods, that is the goods made in USA, will start becoming relatively expensive. The price of the goods will not change, but because of the changes in the exchange rate, because of the depreciation of domestic currency, foreign goods starts becoming relatively expensive to the Indian citizen. Okay, now whenever the foreign goods becomes relatively expensive, obviously it will reduce the import of those goods. So as a result, we will import less of foreign goods. And when we import less, if you can recall previous slide, one of the factors determining demand of foreign exchange is import of goods and services. Okay, whenever import is more of foreign currency will be demanded, and whenever import is less of foreign currency will be demanded. Okay, now here since import is decreasing, so the demand for foreign exchange will also decrease. Okay, will also decrease. Clear? Now if we see the first term and the last term in this flow chart, it clearly shows us a relationship. That is, whenever there is increase in foreign exchange rate, then there will be decrease in demand for foreign exchange. Okay, why does this occur? We have already explained the process why this is happening. Okay, in the similar way, now whenever there is decrease in foreign exchange rate, decrease in foreign exchange rate simply means now previously we were giving 60 rupees per dollar, now we will be giving 50 rupees per dollar. So in terms of domestic currency, we will be paying less to the US dollar. Okay, so decrease in foreign exchange rate simply means appreciation of domestic currency, because in case of appreciation also, as we have discussed earlier in our previous class, Same thing was happening. We were giving less of Indian currency against the US currency, isn't it? So here appreciation of domestic currency takes place. And whenever there is appreciation of domestic currency, from our previous class, again, we know that the foreign goods starts becoming relatively cheaper for the Indian citizen. So since it becomes relatively cheaper, Indian will now start buying more of foreign goods, and buying more of foreign goods means import will rise. They will import more, and whenever there is more import, there will be more demand of foreign exchange. The demand for foreign exchange will rise. Okay, this is how the demand for foreign exchange is inversely or oppositely related to the foreign exchange rate. So whenever there is decrease in foreign exchange rate, demand for foreign exchange will rise, and whenever there is increase in foreign exchange rate, demand of foreign exchange will fall, decrease. Okay, this sums up that there is inverse relation between the foreign exchange rate and the demand for foreign exchange. Now if we are to draw a diagram of this, draw a graph of this, then we will exactly get this type of graph where the demand for or demand curve of foreign exchange is downwards sloping. Okay, here we have plotted the exchange rate, that is rupee per dollar, on the vertical axis, and demand of dollar, that is $100, $200, $300, $400, and similarly increasing, so on. We have shown it on the horizontal axis. Okay, and here when we see, whenever there is rise, whenever there is increase, okay, whenever there is whenever there is increase, okay, in the exchange rate, okay, whenever we are giving more and more units of Indian rupee against dollar, right, from 40 to 50, 50 to 60, 60 to 70, then we see that demand curve is moving upward. That is, we are reducing the demand, okay, for the foreign currency. Okay, is it clear? Fine. So there is inverse relation between the two, that is the demand for foreign exchange rate, the demand for foreign exchange or foreign currency is inversely related to exchange rate. Whenever exchange rate reduces, we will be demanding more, and whenever exchange rate is increasing, we will be demanding less of foreign exchange. Okay, now similarly we will now discuss about the determinants or factors affecting supply of foreign exchange. We have also discussed about factors affecting supply in class 11. We have read about it. Similarly, the foreign exchange, okay, supply of foreign exchange is also affected by some of the factors. Okay, before discussing about supply of foreign exchange, we need to know what this supply of foreign exchange means. Now again, we have to assume that whenever a foreigner is going to purchase our product, whenever a foreigner is going to purchase Indian product, or whenever a foreigner is going to use Indian services like hotel, restaurant, etc., and whenever a foreign company wants to invest in India, or whenever a foreigner or NRIs, non-resident Indians, wants to send money back to their relatives in India, they will be sending money, or they will be investing money, or they will be purchasing Indian products in terms of US dollar. So they will pay US dollar to the country, to India. Okay, now here supply of foreign exchange here means how much of US dollar is being supplied within India, okay, is with the RBI, and RBI is offering it to the Indian citizen. How much of foreign exchange, or what amount of US dollar is with the RBI, which RBI wants to offer it to the Indian citizen. That is known as supply of foreign exchange. Otherwise, supply, if we take only supply of foreign exchange in general, then supply of US dollar can be more. Okay, if we take it worldwide, then supply of US dollar can be very much more. But here, we by supply of foreign exchange, we mean only the supply of, or only the US dollar available within India, which the RBI is offering to the Indian citizens. Okay, and this comes mainly from the foreigners who are either investing or purchasing or importing our products. That is, if we are exporting. Okay, so the first factor which affects supply of foreign exchange is export of goods and services. Okay, export of goods and services. Whenever we export something, whenever we sell something to the foreigners, obviously they will make payment in terms of US dollar to us, as we have assumed. So US dollar is coming to India, and coming to India means obviously the supply of US dollar in India is increasing. Similar for the services. Now, if they come to India to tour, okay, as a tourist, if they come to India and move around different places of India, whether it be Goa, Jammu Kashmir, Himachal Pradesh, okay, Kerala, Northeast, etc., then obviously they will make use of some services, they will purchase some goods, isn't it? They will purchase foods, etc. Okay, then we are assuming that they will be paying in terms of US dollar. If not to the citizen, then obviously to the government. They will exchange it in some of the exchange stores where they can easily exchange the foreign currencies. You will find in most of the tourist places where more of foreign tourists comes, you will obviously see some counters, exchange rate, foreign exchange counters, where they can easily convert their currency, whether it be US dollar, euros, pounds, etc., against the Indian currency. Okay, so tourists are coming along with US dollar with them, and they will make payment in terms of US dollar, and more of US dollar coming to India means supply of foreign exchange is rising. Now, if tourists don't come right now, like in COVID-19 situation, everything is closed down, so no tourists are coming to India from abroad. So obviously here, when there is no tourist coming, obviously there will be less supply of foreign exchange to us. There will be less supply of US dollar in India. So the supply reduces. If export rises, supply also rises. If export falls, supply also falls. Okay. If tourism rises, foreign tourists influx is more in India, then obviously there will be more supply of foreign exchange. And if influx is not more, if influx is less, tourist influx is less, then we say that there will be less supply of foreign exchange. Okay, thirdly, in the same way, if there are some Indians who are working in some other countries, let's say someone is working in USA and sending money as a remittance back to his family members, then it will be known as unilateral receipts from abroad. Okay, unilateral means we have already discussed in case of when we were discussing balance of payment chapter, so I don't think we need to discuss it again. They will send money, a donation or gifts, etc., to India, but it will be in terms of US dollar. Okay, they will be sending US dollar to India. So again, whenever US dollar comes to India, the supply of foreign exchange of foreign currency, that is US dollar, will rise in India. So whenever there is unilateral receipts from abroad, or when there is rise in unilateral receipts from abroad, obviously supply of foreign exchange is going to increase. And whenever the unilateral receipts reduces, or when there is no unilateral receipts from abroad at all, then obviously the supply of foreign exchange, that is supply of US dollar, is going to decrease in India. Okay, last option is investment from abroad. Whenever a foreign company, may it be Apple, Pepsi, Microsoft, Google, etc., YouTube, if they want to come to India and invest in India, then obviously they will come along with US dollar with them. And when they come along with US dollar with them, then obviously India will be having more of US dollar. More US dollar will come to India. More US dollar coming to India means supply of foreign exchange, supply of US dollar is rising in India. Okay, is increasing in India. Now, after discussing all this, we can draw a conclusion over here that supply of foreign exchange and the foreign exchange rate are directly related. Whenever there is rise in foreign exchange rate, okay, supply will rise, supply of foreign exchange will rise, and whenever there is fall in foreign exchange rate, supply of foreign exchange will also fall. So there is direct relation between foreign exchange rate and supply of foreign exchange. Why is it so that there is direct relation between supply of foreign exchange and foreign exchange rate? We will discuss about it now. Okay, why is there a direct relation between the foreign exchange rate and the supply of foreign exchange? Okay, we'll understand this. Let's say when there is increase in foreign exchange rate, as we have discussed in our previous slide also, whenever there is increase in foreign exchange rate, it means that our currency, that is Indian currency, has depreciated. So depreciation of domestic currency. Whenever domestic currency depreciates, our goods, that is domestic goods, becomes relatively cheaper for foreigners. Okay, so domestic goods becomes relatively cheaper for foreigners. Okay, why is it so? We have discussed about this in our previous class. Okay, because of the changes in the exchange rate, the foreigners will start buying more of domestic goods because it has now become relatively cheaper to them. Okay, so they will be importing more from us, that is our export will rise, export of domestic goods will rise. And whenever the export of domestic good rises, as we have already discussed in previous slide, that when export rises, obviously the supply of foreign exchange also rises. Okay, and when export falls or decreases, supply of foreign exchange also decreases. Okay, now if we see this last part of flow chart and the very first part of flow chart, then we can clearly see a relation, that is whenever there is increase in foreign exchange rate, supply of foreign exchange will also increase. So these two have direct relation with each other. When one rises, the other also rises. Now let's take the opposite case, that is when there is decrease in foreign exchange rate. When there is decrease in foreign exchange rate, then from our previous discussion we know that there will be appreciation of domestic currency. Okay, there will be appreciation of domestic currency. Okay, now when there is appreciation of domestic currency, then the domestic goods now start becoming relatively expensive to the foreigners. Okay, so domestic goods becomes relatively expensive to the foreigners. Okay, now since it has become relatively expensive, they will now purchase less. Purchasing less means our export will decrease. So we will be exporting less now. Okay, and when we export less, there will be less supply of foreign exchange. So foreign exchange supply will reduce, will fall. Okay, now if we see this last part of flow chart and the first part of flow chart, then we can easily draw a conclusion that whenever there is decrease in foreign exchange rate, okay, whenever there is decrease in foreign exchange rate, the supply of foreign exchange will also decrease. And whenever there is increase in foreign exchange rate, supply of foreign exchange will also increase. Thus, the question which was asked here has been explained properly using this flow chart. If this question comes in your exam, what you have to do is, instead of making this flow chart, you will just add some words in between and then your answer will be complete. Okay, hope you have understood why supply of foreign exchange and foreign exchange rate is directly related. Okay, now if we are to draw a diagram, we can explain this with the help of a diagram similar to the previous case. Okay, here in this diagram we see that in the vertical axis we are measuring the exchange rate. As we go upward, okay, we will see that the exchange rate is rising from 10 to 20 to 30, 40, 50, 60, 70, 80, and on the horizontal axis we are measuring the supply of dollar, and our supply curve will look like this, that is upward sloping, just like the supply which we discussed in class 11. Okay, now here as we see, when the exchange rate is rising, whenever the exchange rate is rising, okay, whenever the exchange rate is higher from 60 to 70 to 80, we see that the supply of foreign exchange is even more. Okay, so this graph gives us an idea about how the supply of foreign exchange and the exchange rate, foreign exchange rate, are related. Okay, here in case of supply of foreign exchange, we see that in case of supply of foreign exchange, we have written supply of dollar, because the foreign exchange or the foreign currency which we have assumed over here is that of US dollar. Okay, now we will deal with some question and answers, okay, related to this supply and demand, which may come in your board exam. You should remember one thing, since recently CBSE has published the deleted portion of chapters or the topics which are being deleted for this session, especially for the session 2020-21, and from this chapter also, foreign exchange rate chapter, one part has been deleted, that is determination of exchange rate in flexible exchange rate system. So we will not be dealing with the determination portion, but we have just discussed about factors affecting supply and factors affecting demand, and this type of question may come where the interaction is not being shown, determination is not being shown, but it is the application of determination, so it might come. So I have taken few questions over here. The first question is that in the last 5 years, Reliance Group of Industries has been rapidly investing in Australia for uranium mining. What will be its likely impact on the foreign exchange rate of Indian Rupee? Explain. So here what is happening is Reliance, an Indian company, is investing since last 5 years in Australia for uranium mining. They are extracting uranium in Australia. Okay, so how will it affect the foreign exchange rate of rupee, Indian rupee? How is it going to affect the exchange rate of rupees? Okay, so the answer to this will be, whenever there is investment to abroad, obviously we have seen that which part is it affecting, demand or supply. Whenever we are investing abroad, we will require foreign currency, isn't it? Since I have already discussed this, whenever there is investment or purchase of foreign goods, or whenever we are investing abroad, then obviously we are going to demand more of foreign currency, isn't it? So whenever there is investment to abroad, it will lead to rise in the demand of foreign exchange. So demand for foreign exchange will rise, and when there is rise in the demand for foreign exchange, keeping supply as it was before, obviously it is going to have upward effect on the price of foreign exchange, that is the foreign exchange rate will rise. Okay, as we have done this type of applications in case of demand and supply in class 11 also, so we will apply the same logic here. Whenever there is excess demand, in this case there is more demand than supply, so excess demand always raises the price level, and here the price simply means foreign exchange rate, so foreign exchange rate will rise. Okay, on the other hand, how does giving incentives for exports influence foreign exchange rate? Explain. Now in this second case, government is giving encouragement, incentive to increase the export, then obviously it will lead to rise in export of domestic goods. And we have discussed that whenever there is rise in export of domestic goods, what happens? Supply of foreign exchange will rise. Okay, now here we see giving incentives for export will result in the increase in exports, and when export increases, supply of foreign exchange will rise. And when the supply of foreign exchange will rise, what happens is that whenever the supply of foreign exchange rises, okay, whenever the supply of foreign exchange rises, demand keeping the same, demand for foreign exchange keeping the same, here also we see that there will be excess supply of foreign exchange in the market. Okay, when there is excess supply, we know from class 11 that whenever there is excess supply, price is going to reduce. Here price is replaced by foreign exchange rate, so foreign exchange rate will fall. Okay, because of the excess supply. Because supply has increased, demand has remained the same, so there will be excess supply, and when excess supply is there, price will reduce. Price here means exchange rate. Okay, we'll take another question. Visits to foreign countries for sightseeing etc. by the people of India are on the rise. What will be its likely impact on foreign exchange rate and how? Now, more of Indian citizens are now going abroad to visit abroad to for sightseeing or for touring purposes. Okay, holiday, making holidays abroad. So what happens here is when more people will be touring Europe or touring other parts of the country, other parts of the world, when they are going abroad, obviously they will increase the demand for foreign exchange. Okay, so the demand for foreign exchange will rise over here. And since supply remains same, here also the case of excess demand may arise. And when the excess demand is there, obviously price will be pushed up. Price pushed up means exchange rate. Price here means exchange rate will be increased. So the logic behind that is this. In this case, the demand for foreign exchange rate will rise, obviously, because we are, as I have already explained in the first slide itself, tourism. When we are touring abroad, we will require foreign currency. So demand for foreign exchange will rise as more and more of domestic citizens are visiting to foreign countries for a tour. So when the demand rises, supply remaining the same, there will be the case of excess demand. Okay, and whenever there is excess demand, price is going to rise. Okay, price rises here means exchange rate will rise. Price is being replaced by exchange rate over here, so exchange rate will rise. Okay, now the last question. Government of India has doubled the import duty on gold. What impact is it likely to have on foreign exchange rate and how? Now, government has doubled the tax on imports of gold. When the tax is doubled, it will discourage those people who are importing gold from abroad, because obviously higher tax means they have to pay more now for the same gold. Okay, so it will discourage import. The import will decrease. Whenever there is decrease in import of foreign goods, obviously the demand for foreign exchange will fall, decrease. Okay, and when there is decrease in demand for foreign exchange, supply remaining the same, it means that there is deficient demand, or we can say it oppositely, that there is excess supply of foreign exchange in India. When there is excess supply of foreign exchange or excess supply, then obviously price is going to reduce. When price is going to reduce means price here means foreign exchange rate, so foreign exchange rate is going to fall. Okay, so here this move of the government will definitely discourage the import of gold. This in its turn will reduce the demand for foreign exchange, because import is being reduced, so demand for foreign exchange will reduce. When demand for foreign exchange reduce, supply remaining the same, it will lead to fall in exchange rate, because the case of excess supply will arise, and when the situation of excess supply arises, obviously the price is going to fall. The price going to fall here means the exchange rate is going to fall. Okay, so I have dealt with 4 questions over here. You may find so many questions like this in your book, or your teacher may give, or you can find it in sample questions or CBSE questions or many sample papers, etc. So try to solve that. Try to find out, first of all, what you will do is you will try to find out whether it is affecting demand or supply, and accordingly you can easily draw the conclusion from it. Okay, I have attached a link in the description of this video. When you go to the YouTube channel, you will find the description box over there. In the description of this video, I have attached a file. Okay, I have attached a link, of the assessment questions related to this chapter. Please click on that link and try to solve those questions, and you can solve those questions and show it to your teachers, respective subject teachers, and if there is some doubt, they will obviously help you in understanding that particular question. Okay, so do try to solve those assessment questions which will be attached in the description of this video. Okay, so we have come to an end of this chapter and as well as of this unit. Hope you have understood whatever we have learned today. Okay, you have understood whatever we have discussed about today and in our previous classes also. Hope to see you soon. Till then, stay safe, stay at your home, and thank you for patiently listening to my lecture. And please do watch this video again and again in order to understand the topics properly, and wherever you have doubt you can ask your teacher, or even you can contact me in some of the forms. You can even write a comment in the YouTube itself so I could reach you people. Thank you very much. See you again. Stay safe, stay at your home. Thank you very much.